Hello, everybody. Welcome back. Today is Friday. Okay, last day for the session. So what I have planned up here is we are going to attempt some questions on risk management. No promises. I can't probably finish all the areas in risk management in 4 days. Okay, 4 days we covered 5 core areas of the syllabus. The last day I'm keeping it for risk management. So the first half probably today will cover currency risk. If you've got any questions, you can always ask. By the way, all can you hear me? Can all of you hear me today? Just say something so that I know you are there. Okay. Okay. Good. Vasanta says okay. All right. Now, what we're going to do today is on focusing specifically on currency as well as interest rates. I'm not spotting anything here. I'm trying to give equal balance for these two areas of your syllabus. So if you ask me, June, it was interest rates. March, it was currency. September, I don't know. It could be interest rate. Interest rates, the percentage of it coming out, interest rates is like this. Put it this way. There's a 51% chance interest rate is going to be there, 49% chance risk management on currency risk management is going to be there, or probably half. Like the question called Armstrong, it was a mixture. Okay, Armstrong, if you still remember Armstrong, and it's September 15, December hybrid paper. Okay, it was there, balanced mixed paper. Okay, so there can be a mixed paper like CMC where they put in interest rate swaps together with currency, so it could be there staring at you. Now what we're going to do very quickly, we're going to start off with currency risk, which is, let me just hide the control panel. Okay, now we're going to do a question called Lirio. Lirio is a nice question, 50-mark question. What I'm going to focus on is only on the appendix part relating to part 2 of this question. Advises Lirio company on and recommends the appropriate hedging strategy for the euro receipt. It's going to be due in 3 months' time from the sale of the equity investment. So you are going to receive euro. When you receive euro, what are you going to do? You don't want that euro. What will you do to that euro? Anybody can answer that. You are going to receive euros. You are not in the eurozone. Okay, definitely you're not in the eurozone because this is currency risk management. If you're going to receive euro, can someone tell me what will you do to the euro? Because that is very important to answer this particular hedging strategy. If you're going to receive euro, you will sell euro. Very simple. You will what euro? I'm asking you, you will what euro? You will sell euro. That's good. I'm not bringing the other currency because I don't want you to talk about that currency first. Okay, so we have not seen what is the other currency. So if you receive euro, you will sell euro. Very good. You will sell euro, and obviously you're going to use you're going to buy some other thing. You're going to use this to sell, and you're going to buy some other currencies. Okay, now 14 marks here. We're going to get 14 marks. That's it. And this question tests us basically everything except for money market hedging. Okay, money market hedging, we're going to give it a go. Okay, we're going to just give it a go. I'll tell you what questions to practice for money market hedging if we have time at the end of the session, which I don't think we'll have. Okay, I come back and try to attempt money market for other questions Okay, now I just want to highlight to you the important area. We're not going to read the whole story here. This is where you need to look at this page 27. Below that, above that last paragraph on page 27, you have the sale of equity investment, okay, in the European country. Now, you're going to sell an equity investment. Normally, it's an importer or an exporter. Usually, that's the question. But this time, you're going to get something called sale of an equity investment. You will receive euro 20 million in 3 months' time. By the way, just a quick introduction of Lirio. Lirio is a company going to be not in Eurozone, definitely not in Eurozone. Lirio is in a country where it's a dollar country base. Is that okay? It's a dollar country. Don't worry about this 40 million. It's in a country where dollar is their currency, okay? Now, it is expected that Lirio will receive 20 million euro in 3 months' time, very important date, from the sale of its investment, okay? It will receive in 3 months' time from the sale of the investment. The euro has continued to remain weak, while the dollar has continued to remain strong. If you're going to sell euro, just now you told me you receive euro, you sell euro. If you're going to sell euro, and if euro is remain weak, that is the worry that we have. Is that okay? That's the worry that we have. So you need to do something to protect that particular euro. Dollar is remain strong. If euro is weak, obviously dollar is going to be strong. The financial press reported that's a permanent shift. Okay, don't worry about that. That is going to talk about this part 1 or part A of the question. Yeah, you can have a read. Purchasing power fluctuations, economic risk, and stuff like that. Okay, what we are interested is decided to hedge euro receipts. You're going to have a euro receipts 20 million using the currency forwards, using currency futures or options. You're going to choose one of it. The one that is going to give you the highest dollar end of the day, forecasted dollar, I'm talking about forecasted dollar end of the day, will be chosen. Okay, quick one. You have got 3 months story here, rates available to euro. Just be careful. This is actually dollar per euro. Euro is the base. Spot rates, you have it here. The low rates and the high rates, and 3 months forward rates is also given. Questions is telling us it is a 3 months, so you don't have to worry about adjusting the forward rates. Sometimes they give you 4 months, then you need to interpolate to get the 3 months on a linear change movement. Is that okay? You just do it on a linear change movement, get that rate. That's not a problem in this case. In most cases, it's not a problem. Usually, the examiner will give you the exact date for forwards. Yeah, the old question, I've seen 1 or 2 questions that they didn't give you. Okay, but this is so far so good. Currency futures, I wanted to highlight this dollar contract. The contract is denominated in dollar. You could have get a contract denominated in euro. So this is a dollar contract. Again, I want you to be careful with this currency here. This is in euro per dollar. So that is inconsistency in this exchange rates. This, I think, probably would have caught a majority of the candidates in exam, especially the forward one. They are so used to, they will be used to this one, but probably this is going to be tricky a bit. Okay, so if you got 2 types of currency code, you can either use it as it is, or you change this to whichever format that you like. If you don't like this format, then you change this to, you reciprocal the thing, and you're going to change 1 over into this, 1 into this, and you can change it, and you to the currency that you like. I'm not going to change it today. We don't have much time in exam usually. Today I have no time as well because we are rushing to do two big questions here. So in exam, if you want to change. If you feel uncomfortable with these two different sets, direct, indirect quotes, you just change to whatever you like. Okay. For example, how do you change this? For example, how do you change this? You want to change, let's say you want to change dollar to euro. You just change this to 1 divided by this. Is that okay? 1 divided by this, and you just do it. But it's going to be tricky because if you want to change this, then all this have to change. Yeah. So best is leave it, or you just change this. This format, I think students are very used to it because the home is $1 is the base. Usually you're comfortable when your home is the base. But this one, your foreign is the base. Your foreign euro is the base. So people are not comfortable with a foreign as a base. Most of us are comfortable with dollar, or in this case, your home as a base. So usually, if you want to change, I would suggest you, if you really want to change, you change this. Otherwise, just leave it there. See how to go about it. Okay, currency futures, you have that. Currency options. Okay, again, this is a dollar contract as well. There's no connection between this. There's no connection between these two. It's a totally independent contract. Unlike the interest rates, it's linked. It is linked. Options is on the futures. Is that okay? And the premium and all that, we're going to come back to that later, and we're going to see it is assumed that the futures and options expire at the end of the respective months. Okay, so that's going to be the question. We're going to have just one appendix here. Just put it in the appendix because this is an appendix. It will be in one of your appendix, probably appendix 2 or appendix 3. So first thing we're going to do is going to be, to summarize it, the exposure. The exposure will be euro receipts. Euro, 20 million, okay, 20 million receipts. So the H will be, there's 3 H that you can learn from this question. The first H that you're going to learn will be receipts forward contract. We're going to use forward contract. Okay, we're going to use forward contract. Now, you're going to tell me now, you're going to get 20 million. I'll open up the whole figures here because we don't want decimal points. Sometimes you're not comfortable with decimal. I'm not comfortable with decimal. Let's open up to $20 million. Now, you're going to tell me you want to find the dollar. You want to find the dollar. You're going to find the dollar. Okay, dollar per euro. 1 euro is so many dollars, either low or the high rates. Okay, so what we're going to have, we're going to see forward rates. So forget about the spot rate. It's either one of these. Is that okay? So you focus now. Let's say worst case scenario, you're not sure. Okay, you're going to have 2 rates to choose from. Some students not sure whether to use the high rate or the low rate. Today, we're just going to make it simple. We don't have time to go through the very basic and start from the direct quote, indirect quote, all that in exam. Today's webinar is about exam technique. You panic, you're not sure what rates to use, but you must know whether you're going to multiply or divide. Can someone tell me you're going to multiply with one of these rates or divide with one of these rates? 1 euro. 1 euro is going to be either so many dollar, 1.1559, or it's going to be 1.1609. So my question is 20 million euro. 20 million euro is going to be less than 20 million or more than 20 million. Now, we're not memorizing anything here. Yeah, we're just telling you in case you panic, you forgot, you're not sure whether you're going to multiply or divide. It simply means 1 euro, it's more dollar you get. Can you see that? 1 euro, you get more dollar. 20 million euro, you're going to multiply or divide. Can someone tell me Okay, everybody is typing multiply. Okay, one person divide. Now multiply. Okay, we're going to multiply. Make sense? Does it make sense? If you're going to divide by 1.1559, the figure is going to be small. It doesn't make sense here. Okay, so it has to multiply. You have your own ways to remember. We have everybody has their own ways, but I'm just teaching you as though you have never learned before. Okay, and this is what you're going to do. You're going to multiply. Yeah, I think most candidates would have divided as well, because they are so used to dividing in the exams. Trust me. Yeah, most of the questions are divided, but not this one. So you're going to multiply. Okay, you're going to multiply with one of these rates. Now, you're going to multiply with the lower rate or the higher rate. Now, I'm going to assume you have got no basic, zero knowledge here. Okay, let's assume everybody, let's say I also don't have knowledge, you also don't have knowledge. Now we're going, multiply. Everybody is multiply. Just now the person who said divide, I don't want to mention your name, but are you okay to multiply? There's one person. Okay, very good. I don't mention your name. All right, good. Now you're okay with that. Now you're going to choose the higher rate or the lower rate. You're going to choose the higher rate or the lower rate. Worst case scenario. I'm sure there are methods. I have methods, but we don't have time today to teach you all the methods. Okay, simple. Make it simple. You're going to take the higher one or the lower one. Very simple. You are going to receive. You are going to receive. Okay. Banks are the one that's always going to make money. Okay, banks make money from you being an intermediary. You are going to receive. You told me you are going to multiply. If you are going to multiply, you tell me you will end up receiving more or you will end up receiving less. Can you please type it in, please? More or less. Bank make the money, not you. Lirio is a company. Lirio is a company. Okay, can you please type in? You are going to receive more or you are going to receive less. A clue: bank always make money. Okay, you are going to receive less. Okay, because you're multiplying. We are multiplying. We are going to receive less. Okay, everybody is good. Okay, there's one guy says higher rate. Are you going to change your are you okay? I'm not going to mention him. Okay, I'm not going to mention it. Everybody's saying less except for one here. Okay, if you choose higher rate, okay, if you're going to choose the higher rate, the bank will be crying, isn't it? Bank is, because if you choose the higher rate, you end up laughing. Okay, you are supposed to receive less. Okay, are you guys okay? You have to use the lower rate, which is 1.1559. Okay, we're not talking about any high rate or low rate, buy low, sell high, buy high, sell low. All this today, we're going to keep that aside. You have your own method. Okay, many people have their own method. I'm not going to confuse you with my method. I have my own method, but today I think if I talk that method, I need time to explain that method. Now we go on reverse psychology. We're playing psychological game with the marking team now. Okay, you know it's going to be the lower figure. Well, it's going to be 23118.00. Guarantee you're going to get that 1 mark that you deserve. Okay, forward contract done. All right. If you are going to go to the next one, which is going to now futures, let's go to the futures. Well, futures and options, you can put them together if you want to. The hedging strategy, you can put them together. I'm just going to put them separately just to make sure that we don't mix things up. For this one, we're just going to put them separately. Now, we are going to receive. Okay, we are going to receive. Okay, just write this first. Okay, we are going to receive euros. We are going to receive euros. $20 million. Okay. Okay. Wait, let me see some questions here. Well, we'll come back to futures. We'll come back to futures. You have already put the word there. Let's see whether you're correct or not. Okay. Now, you are going to receive this futures also. I'm going to teach as though you have never heard of any strategy before. Okay. Let's keep it simple. End of the day, put it this way. We just want to pass this exam. Is that okay? We just want to get the correct buy or sell. Get your marks, okay? Maybe more than 50 marks, okay? And graduate, okay? So receive 20 million euros. Okay, this is what you're going to receive. Now the question is, you're going to receive. Now I'm just going to put this maybe outside my mind or outside the exam paper or outside this answer script. I will sell euros. Correct? I'm going to sell euros. In other words, and I'm going to buy, using this, I'm going to buy dollar. That's what we're going to have. Okay, you're going to sell euros and you're going to buy dollar. Okay, you're going to sell euros and you're going to buy dollar. Okay, the futures rule is this. The futures rule is this. You are going to gamble. Yeah, you're going to gamble in another market. It's a two-market system. One is the cash market, whereas you're talking about export or import. In this case, is receiving money. The other market is you're going to take a gamble. It's a derivative market. So if one market you win, the other market you lose. If one market you lose, the other market you win. So now the rule of the futures, just remember this. If you know something is going to go up, what do you do today? If you know something, maybe your price of your house, okay? Your price of your house, something. It could be a house, it could be a car, it could be your shares, it could be anything. In this case, we're going to talk about derivatives. If you know the derivatives is going to go up, what do you do today? Anybody come type in it. If you think it's going to go up, what do you do today? What do you do today? What will you do today? If you know it's going to go up, what will you do today? Do you sell now and buy later? Buy now and no, I'm not asking you later. I don't want later. Today, what are you going to do? If yes, most of you got it correct. If you know it's going to go up, okay, put it this way. You want to buy a house and you think the price of the house 3 years time is going to go up like crazy. Today, what do you do to the house? Come on, answer me. House, put it as a house. Currency, all of us are confused. Interest rates, all of us are confused. If the price of the house is going to go up, what do you do today? Come on, answer me. Yes, buy. That's it, simple. The thing is just buy. We don't want to know buy now, whatever later. We just know today we will buy. That's it. Yeah, most of you got it correct. In fact, all got it correct. So today we will buy. Okay. If you know whatever you have today, let's say you have it today, and you think that, let's say you have a house today, and you know the price of the house is going to go down due to some changes in these what do you call this, government planning or whatever. Maybe a train is going to pass by your house, okay, something like that. If you know that you got a house and if you think the price is going to go down, what do you do today? If you think it's going to go down, in the future it's going to go down. Today it's going to be here, but tomorrow it's going to go down and down and down and down. What do you do today? Come on, type it in. What do you do today? Buy or sell this particular house today? Got some answers coming in. Okay, sell. Very good. Sell. Okay, very simple. So this is all in these things. You just remember, if anything that you think is going to go up, today you buy. Anything if it's going to go down, today you sell. Is that okay? If you're still not sure, put it this way. Girls, remember this better. Gold, all right? Gold, jewelry. Okay, my wife always tells me price of the gold going to go up, so quickly she goes to the shop, jewelry shop, and she quickly picks up all the golds she buys today. And when the price going down, I quickly tell her, faster, 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 you have to sell. And she can't hear what I'm saying. Is that okay? Supposed to sell, isn't it? You're supposed to sell. Yeah. If it's going to go down, you sell. If it's going to go up, you buy. Okay, good. I'm going slow here because I know this topic, you will ask me why buy, why sell. So I know you're going to ask me in advance. So we're preparing for that type of questions here. Okay, you're going to sell euro. Okay, you're going to sell euro. So the question is now, and buy dollar. Okay, question is, the H strategy is buy or sell. Buy or sell. All this you can write in the exam. Buy or sell. It's going to be, look at this one now. Okay, like put it this way now. If it's sell euro, if you're going to sell euro, your worry, your downside risk is, yeah, the euro is going to be weaker. Is that okay? The downside risk, you're worried that the euro is going to be weaker. If you're going to buy something, what are you worried? If you're going to buy a house, what's your worry? It's going to be stronger. Your worry. Is that okay? Your risk is going to be, you think if you're going to buy dollar, your worry is it's going to go up. If you're going to sell euro, your worry is going to go down. But forget about all that. Let me teach you a simple method. Now, this is a dollar contract. Okay? Full stop. Dollar contract is this. Therefore, dollar contract is that figure. We have to choose the contract here. Dollar contract, therefore you need to buy dollar contract. So this is going to be, you need to buy dollar futures, full stop. No need to think anything. You just get this out and you just get it in. Understanding, probably we take it outside. You can email me or whatever, but today we just want to answer this question. Okay, you get it? If you're going to receive euro, this is very important. The one in the red color here is very important. If you're going to receive euro, you're going to sell euro. Okay, you're going to sell euro. You're going to receive. Let's say you work in France, they pay you in euro. You come back to your home, the euro in your hand is useless. What do? You go to the bank or money changer and you sell that euro and you buy your home currency. Write this out first, and then you're going to see the question here. Oh, it's in euro. Sorry, it's in dollar contract. So what is it saying? Buy dollar. In other words, in futures, you have to do the same thing. You have to buy futures. Full stop. Okay. The time will be, what time is it going to be? Well, it's going to be in 3 months' time. Is that okay? This is going to be happening in 3 months' time. So you must choose the contract that can still be valid for the 3 months. Okay. So is it March today? What's the date today? I need the date. I need to tell you the date. Where's my date here? Okay. Okay. Today is 1st of March. Today is 1st of March. The date is going to be 3 months from today. 3 months from today, can you please tell me what's going to be the date? Meanwhile, I answer some of the questions. Okay. Okay. Everybody talking June there. All right. No, what's the exact date? Can you give me the exact date of this particular thing? What is the exact date if you talk about 3 months from 1st of March? 1st of June. Steffi, thank you. Thank you. All right. Thank you. I hope I'm getting the name correct. Okay. Tanzim, you said 30th of April. Now, 3 months from today can't be 30th of April. Is that okay? Because March is the whole month of March. April, 30th of April, it's only 2 months. Is that okay? Correct? March, whole month is 1 month. April and May will be the whole month of May. But you don't say 30th of May. Reason simply being 1st of March. If it's 1 year from, let's say you celebrate your birthday. When do you celebrate your next birthday? You're born on the 1st of March. Your first year birthday, are you going to celebrate on 28th of February? Are you going to celebrate? No, you're not going to celebrate on 28th of February. 1 year from now is 1st of March next year. Is that okay? So everybody okay with 1st of June? 1st of June. Time will be 1st of June. Therefore, you're going to choose the contract that is still active. You can still squeeze in to the June contract. Is that okay? You can still squeeze in to the June contract. Where is it? Okay. Yeah, we got a March contract and we got a June contract. So we're going to squeeze into a June contract. Therefore, we'll choose a June contract. Now, when I say you're going to choose, now you're going to get marked for this. You're going to get a mark when you tell buy dollar futures, you get a mark. You say June contract, when they give you more than 2 contracts, you may get a mark. Yeah, there's sometimes allocation for 1 mark for choosing the right contract. Okay, so you're going to get mark for June. Examiner said 3 months simply because when you see the word March, many would have dived in March because they say March is the 3rd month in the calendar year. Okay, there will be some people choosing June, choosing March. So this is going to be a June contract, still valid, and you still have a 1 month expiry to go. Is that okay? 1 month expiry to go. So what you need to do now, this is the new examiner. I mean, I'm not saying new examiner. He's kind of old already. Okay, it's since December 2010. He likes the lock-in method. Okay, he likes the lock-in method for currencies. You can use basis method. Go ahead. I'm not saying you are wrong. Basis methods takes a bit of your time. You use basis methods if you know exact what do you call this, rates in the future. Otherwise, it's good to use the lock-in rate. Use the lock-in rate basis method. It has been tested once. Yeah, it has been tested once in currency. That's what I was told by students. Yeah, I don't know anything that comes out in the exam. Students only tell me that the basis was tested. But if you want to do the basis method, just do as though you're doing interest rates. Okay, exactly the same. But majority of it is going to be lock-in rate. So what we're going to do is time. You got this thing. Now you're going to find the lock-in rate. The lock-in rate. I'm going very slow. I hope you all understand. But my worry now is I'm more worried that I can't finish everything that I planned today. Okay, the lock-in rate is going to be 31st March given. This is, you just use the futures rates that is given. You are given 2 futures dates here. Futures dates, March and June. So we're going to have March. We're going to have March, which is 0.8638. And you got here 30th of June, which is going to be, June. We're going to have here 0.8656. Okay. Now we are closing it earlier on 1st of June, which means we are going to forecast the futures rate to be in between these two, and we assume the change is linear. The change is linear. So what we're going to do, we're going to now guess what's going to be on 1st of June. We're going to guess this on June. So we're going to, you can choose the top or you can choose the bottom. If you choose the top to come down here, I'm going to use that. Here to here, it's a 3 months gap. Here to here is how many months gap. Here to here is how many months gap. I'll take some questions. 1st of June. Okay. Tanzim, are you okay with 1st of June? You're typing 2 rates there. 30th of April and 31st of March. Tanzim, okay, you're good. All right, just want to check. No problem. Don't need to say sorry. Okay. Now, you're going to have here, how many months here? Anybody? Typo. Okay, no worries. 2 months, Dinesh is back. Yeah. All these are regulars. Is that okay? I'm going to miss you guys after today. Okay. I hope you can participate in all my webinars. Yeah. Okay. So we have here 31st of March, 1st of June, 30th of June. Now, 2 months. So we're gonna follow it to here. Now you can see this is 38. There this is 58. So this is increasing. Okay, the trend is increasing. So you're gonna have here 8638. You're gonna plus with the change is 2 months over 3 months. The difference between this is a 3 month. The difference between this is a 2 months. You guys okay? We are just doing interpolation. 0.86, take the highest one. 56 take away 8638, and you're going to get something like this. 0.865. Check 0.8650 if you want to put 4 decimal places. So you check, you put it inside and see whether it makes sense or not. 0.8650. Is it increasing? Increasing. Okay. You can also start from bottom to go up. Then you must put this here, and here you change this as 1/3. 1/3. Okay. Listen carefully. Finish. You're going to get 1 mark for this. You will get a mark for this. Lock in rate. Okay. Don't waste your time using the basis method for, unless the question tells us the actual spot rate in the future or the actual future predicted approximity rates in the future. Otherwise, just use the lock-in rate and move on. Okay, you already have this already. Once you have this, we're going to straight away go into one more. That is the number of contract. Number of contract. Okay. Now, so these are the things, 4 things I would like to say. 1 is buy or sell. 2 is when, time. 3 is lock-in rate. And the next one is number of contract. Put some space so the examiner or the marker can see the, what is this? If you want to box it up, go and box it up. Okay, easy to mark. Seriously. Buy, June contract, you get marked. You get a mark for lock-in rate. Number of contract is going to be the amount that you are going to be exposed. In this case, you're going to receive 20 million euro, and the contract is denominated in dollars. The contract is denominated in dollars. So let's try to divide by dollars 125,000. Can we divide? Can we divide euros with dollars straight away? We can't, isn't it? We can't divide euros with dollars. So what you have to do? No, very good. Yeah, waiting for name this person. Okay, we can't divide with dollar. What do you have to do? You just change this to dollars. Is that okay? You just change this to dollars. How do you change this to dollars? Well, if you look at the forward rates, okay, if you look at the forward rate, we multiply to change to dollar because it was such that the currency was quoted in that manner. but this is in this manner. Okay, the lock-in rate is in euro per $1. The lock-in rate, this is our lock-in rate. Sorry, I should have put the lock-in rate is euro. This is euro. So much of euro for every dollar. So much of euro for every dollar. If your euro is small, yeah, you get more dollar. Okay, so what you must do now, earlier you multiply. In this case, you need to divide with this rate. Euro 0.8650 per dollar. Euro gone. So you end up with dollar. So we are going to get approximately 184.94 contracts. 184.94 contracts. Now, your examiner so far for futures always tries to give very close, beautiful contract. Usually, if I can recall, in fact, all the questions are very close to a round number. So we're going to take this as approximately 185 contract. You're going to get a mark there. Is that okay? Okay, you go slightly more, it's okay. It's okay. The company can bear that risk. Yeah, slightly more or slightly less doesn't matter. Very good, Dinesh. Yeah. Because we divide this. Once you divide this, you're going to change this to dollar, and you're going to get the dollar sign. Okay. Well, that's it. We are now going to go to the outcome. The outcome, it's simply going to be the expected receipts, which is equals to euro 20 million. And what you're going to do is the expected receipts is kind of like a lock-in already. Whatever happens, you win here, you lose in the other side, or you lose the other side, you win here, or win there, lose here, whatever it is, you know the outcome is locked in at the rate, which is going to be the lock-in rate, which is going to be 0.865, and you're going to get in dollar 23,121,387. Is that okay? 23,121,087. That's about it. Simple as it is. Okay. Any questions? You get 1 mark for this. You get 1 mark for this. So futures, you've got like 4 to 5 marks. Is everything clear before we go to currency? Yes, you can round down. If you can round down because you want to save transactions costs, okay? But I think 184.94 is very close to 185. Contract size relevant in futures? Yes, it is relevant in futures because this is contract size. It is relevant in futures. Contract size are important. Well, a small tip for you: if it's going to be over the counter, if you're going to do this particular thing over the counter, usually options you do it over the counter. You can do over the counter. Okay, if you're going to do any derivatives over the counter, forget about calculating number of contracts, because usually they won't give you the contract size. If they give you contract size over the counter, then you still have to go and do a number of contracts. Is that okay? Most of the time over the counter, you can hedge 100% of it. Okay, I think it's clear. No questions already. Let's go into options. I'm a chair. Why are you saying? Okay, now 3-point. Wait, if you're going to divide this with this or June contract, yeah, you won't get marks. This must be the lock-in rate. Okay, if you're going to use the other one, then you must go and do the basis method. Here, this must be the lock-in method. Okay, but let me just tell you, there's another way of finding lock-in rate, which means you are going to use, instead of 1st of March, sorry, 31st of March, you can also use, what date is today? 1st of March, you can use the spot rate here to determine as well the lock-in rate. Yeah, you can use the 1st of March, today's spot rate, which you got to be carefully taking the right one. And then you can also do that. But if they give you two contracts, which is most of the time, just choose that two. No need to go so far to the spot rate, yeah, and forecast the lock-in rate that manner. Okay, can I go on to options? Okay, since she said which spot rate, well, it's going to take some time answering that one. Come, let's go. Since you asked me, I have actually triggered you to ask. Okay, never mind. If you're going to take the spot rate, it's going to be either one of this. Let's get rid of this, okay? Okay, by the way, which rate did you choose for futures? Which rate did you choose for forward just now? Answer me first. Which rate did you choose for forward just now? 5.9 or 601? Which one? 5.9 or 601? Which one you choose? 5.9. Very good. Okay. So the spot rate that is going to be deemed to be in this grouping for receipt of euro is going to be 1585. You okay with that? So this is the spot rate that you have to choose. But I can't bring this rate into here. I can't bring this rate of 1 point, what is that? 1.1585. I can't bring it because this is in a different format. What do I have to do? What do I have to do? I need to reciprocal the thing. So I just use that 1 divided by 1.1585, round up to 4 decimal places. Anyone have this figure? Anybody can help me out with this? 5.9. Okay. Everybody think 5.9. 1 divided by this. Okay. And you are going to get 4 decimal places. Anyone can help me out? I'm not going to calculate today. It's a Friday night. Okay. I hope you all are good. Okay. So this is going to be, what's the rate? Anyone? What are you guys doing, man? Come on. Give me the rate. You ask me, you tell me. Okay. 080 Tanzim is saying 8631. Okay, so this is going to be 863. I'm going to take Tanzim's answer. This is going to be 0.8631. And you're going to use this to forecast that 1st of June rate. Is that okay? Okay. Who asked me that question? Which rate? Who asked me the rate? Which spot rate? Okay. Yeah, Murtaza asked me, right? You okay? Oh, she didn't round off. Okay. So, okay. Arab Sultan is very detailed. Very good. Thank you. Thank you, Arabs. Okay. I need you. Okay. It's my assistant. Now, so you got that already. Fine. Good. Now we're going to do the options now. Options is going to be same story. Okay, option is going to be same story. Time, what do you have? Options, just remember, call or put. Call or put. Well, you go back here. We're going to use this red color information here. You go back here. We don't want to beat around the bush and come here. We don't have time to beat around the bush in this revision session. For this, we don't have time. Okay. Sell euro, buy dollar. What contract size is it going to be? The contract in the option is $1, so you need to buy dollar. Buy dollar means what option that gives the right to buy? Come on, answer me. What option that gives you the right to buy? What option gives you the right to buy? Anybody? Buy option. Buy. A right to buy is going to be a call option. Everybody got it right. Very good. Okay. So it's going to be a call option. Okay. Now, one more point I want to stress here. Call or put is going to be a call. Let me tell you something. If we, for currency alone, you must remember this, or put it this way. If you are scared to die, you buy insurance or you sell insurance. Answer me. You're scared to die. You are scared to die. You buy insurance or you sell insurance. You're afraid to die. Buy. Okay, buy insurance. All right. It's going to be a buy. In currency option, it's always a buy option. It's either a buy a call or you're going to buy a put. Nothing else. So make sure you have a pair answer to get a mark. You're going to buy a call option. Don't go and say sell a call or sell a put. Always remember currency, it's a buy a call. I've not seen a caller currency as much as I can remember for the past 20 years. Not even in this P4. Since the introduction of the paper called P4 in 2007, there was never a caller currency. So we make it simple. For option, for currency, it's always a buy. It's going to be a buy a call or buy a put. Buy a call gives you the right to buy. Buy a put gives you the right to sell. Okay. How you know it's a call? One more time. How you know it's a call? The amount that you are going to, in this case, receive. This is very important. You're going to receive this, so you're going to sell and buy this. You're going to receive this. So what are you going to do? You're going to sell this. Okay. Most of you are from a country, maybe from Pakistan, I suppose. Okay, or maybe some Middle East or some other place. If you're going to get another currency, what's the first thing you do? Now, I teach in a few other countries as well. When I go to that country, they pay me in US dollar. When I get the US dollar, I come back home and I go to money changer and I sell that US dollar and I buy my currency. Is that okay? So that's what you must do. So you must look for this contract is very important. That's it. Okay, we're not trying to understand what we're just trying to pass this paper. This is prepare to pass series of webinar, I suppose. Is that okay? So we make you pass. That's it. Okay, so it is going to be, we are going to go for buy a call. Okay, buy a call option. You're going to get a mark. The next thing we're going to do is going to be your, what's the next thing we usually want to do is the date. The date will be like in this options in the futures or so, we choose a date. Time is going to be 1st of June as well, 1st of June, and you're going to go on there. Okay, 1st of June. Okay, 1st of June. You're going to have, what is your, First of June, right? Yeah, 1st of June. Okay, let's get rid of all this. Get rid of all this. So we are going to have a call. So you throw away the put, left with the call. Okay, throw away the put, left with the call. Now we only have one exercise price, so it's going to be that exercise price 0.8600. So we're going to have to choose, no choice here, we're going to choose 8600. This is euro per dollar. This is euro per dollar. Okay, so that's what you have there, 8600, done. And the next one is going to be number 3. You don't have to find lock-in rate here. You don't have to find lock-in rate. What you have to find here is the number of contract. Is that okay? Number of contract. Very simple. You take your amount of your hedge, which is 20 million, and you try to divide with the contract size, which is in dollar denomination, which is going to be $125,000. Can you divide dollar with euro with dollar? No way. So what you have to do, you have to change this to a dollar. Dollar is the base. Okay, so we are going to use, what rate do you use here? Anybody can tell me what rate is used? For future, it's advisable to use the lock-in rate, okay, to find the contract size. For options, what rate do you use here? We're going to use the what do you call this, exercise price. Is that okay? We're going to use exercise price, which is the best rate. Is that okay? Exercise price, this is the rate you think you're going to do. So you're going to divide it with 0.8600, okay, and you're going to get a rate here of how much? Options, how many contracts it's going to be? Roughly, is it exactly 186? Yeah, 186, about there. Okay, technically it is 186.05. So I'm just going to ignore that, the difference. You can just ignore and just tell the note to the examiner, small matter. Yeah, you can leave it unhedged. Yeah, you can leave it unhedged and assume company can bear the risk, something like that. Okay, you're just going to leave it there. You're going to get this figure 1864. Okay, very close. So examiner is that. So I'm just going to use 186. Okay, now then what happens? Finish. You're going to get 1 mark for this. You're going to get 1 mark for this, and so on. Okay, 186. Slightly you're not hedging. Is that okay? Slightly you're not hedging. Okay, what the examiner will do is the balance of the 0.05, he will take that out and he will do a forward contract for that. You can also do that method. In fact, that's the best way. But sometimes when time is constrained, you just make an assumption, small amount. No hedging is also a strategy. Remember, no hedging is also a strategy. Very practical. Small things you just ignore. Otherwise, you just have to take the 0.5 out and you go and do the forward contract. Okay, always try to round down. I always try to round down any options contract. If it's like 186.6, I'll still round down. 186.7, I might still round down because options are expensive. Is that okay? The 0.7 we can do using forward contract, or leave it unhedged is also an option. Okay, so we'll just leave it at 186. Okay, and we're going to go for the outcome of the option. Now the outcome of the option, I don't know what's going to happen. So what I'm going to assume is, I'm going to assume the worst case scenario. That means I assume we will exercise. Okay, since you asked me over hedge or under hedge, how do you calculate? Let's do it since you asked me. If you don't ask me, I would have just moved on. Okay, this is going to be a bit longer. Okay, come, let me just show you. If it's over hedge, under hedge, maybe in the exam you're going to have over hedge, under hedge. Okay, now if that's the case, you're going to assume that you're going to exercise. You have 186 contracts that you went for. Is that okay? So 186 contract, 20 million euros at 0.8600 would give you an amount of 23,255,814. That's the dollar that you're going to get. But you're not going to protect all these dollars, because your dollars is going to be worth 125,000 multiplied by 186. So how many dollars are you going to get protection with? The amount that you're going to hedge out of this 23,255,814, it's going to be, how many contracts are you going to get? One amount of your hedge. The hedge amount you're going to have here, $125,000 multiplied by 186. You're going to protect yourself with $23,250,000. Is that okay? $23,250,000. Now, therefore, the amount not hedged is that 0.5 contract. You just take this minus this. You take this minus this. Can you please calculate? If you can type it out, it would be good. You take this minus this, and if you type it in, okay? I just want to make sure that you are still active. Okay, you're going to get an amount that is not hedged, which is going to be amount not hedged. Let me see your answer. 5814. Okay, so you're going to get amount hedge is 23,250. Okay, amount not hedged, very close to, wait, give me a minute, this is 23255,814. okay, because usually I don't do this method. Yeah, I don't. A small amount, I just go on, I move on. Yeah, I move on. Okay, this is going to be what, 5814. Is that okay? 5814. Okay, so keep that in mind. Keep that in mind. 5814. Sorry, you don't do that way. Amount not hedged is going to be this. Amount not hedged is going to be 20 million euro. Okay, minus off with 186,000 multiplied by 125,000 contract. Now you have to multiply this one now. Multiply. Just now you divide. Now you multiply with 0.860. What's the figure here? Well, this is going to be, how much the figure? This is your amount not hedged. Because this is the one that is hedged. Okay, the one that is hedged is this. So you need to work out what is not hedged. The figure is going to be 5,000. Ahmed, yes, correct. Okay, it's going to be 5,000 euros. 5,000 euros is not hedged. Think about it. 186 is hedged. The 0.05 is that 5,000 is not hedged. Okay, so we keep that in mind. Now we're going to go into the outcome. The outcome will be, the outcome is going to be, let me go to the next page, okay? Let me go to the next page. The outcome is going to be 23,250. This is confirmed. You're going to get whatever the case is. This is confirmed. Worst case happens. This is yours. This is yours. And you're going to get some more. The amount not hedged was you went into forward contract. Okay, forward contract for the not hedged amount. Not hedged in the option. Okay, which is just now how much? 5,000 euros. And if you go forward contract, what was the rate we used just now in the first part? We have to multiply with 1.1559. Think about it. The balance, you need to go to forward. Forward has been tested earlier. It was 11559. So you're going to receive another $5780 in your country. And don't forget, options are expensive. You have to pay premium for it. The premium that you're going to pay will be here. You choose a June. You choose a June premium. This is a premium. This is euro. This is euro per dollar. This is also euro per dollar. That means this is in euro format. This is euro premium per $1. Euro premium per $1. 0.029 per $1. How many dollar actually you are going to go? One contract got $125, which means you're going to pay so much of euros. And you're going into how many contract? Exactly 186 contract, which is going to be how much? This multiplied by this, multiplied by this. Help me out. This is going to be a figure of euros. It is still in euros. Am I right? This is still in euros. This is still in euro. Let's see what you got. 67.4. Okay. 67.4250. 67.4250. Okay. 67.4250. And this is in euro, but this is all in dollar. What do you have to do? Premium, you have to pay. Of course, you are in a dollar country. You have to pay in dollar. My question to you is, when do you pay for the premium? When do you pay for the premium? Do you pay for the premium today? Or do you pay for the premium? Or put it this way, when do you buy insurance? Before the lorry knock you down or after the lorry knock you down? When do you pay? Yes. Yeah. First day. Very good. First day means you have to use what rate? First day. Very good. Wayana is back. We have to use spot rate. Spot rate is what rate? You are going to pay now. You are going to pay. Earlier, you receive. You use the low rate. Now you're going to pay. You multiply. Remember, you're in a multiplying mode. If you're going to pay, you need to pay more. So you need to use the higher rate because you're multiplying. Nothing got to do with left hand rate, right hand rate, buy low, sell high. I'm not talking about it. But in class, my personal class, I use that to confuse the students. Is that okay? Seriously, I use that to teach in class. But today we are running out of time. So what do? You remember, you always end up paying more. Very good. All of you got the right rates. Yeah, you all are going to pass this paper if it comes out. 1.161 multiplied by 1.161 giving you an answer of in euro. This is a payment. I'm going to put a bracket. Check. Is it 674,250? 674,250. And there you go. You're going to receive this figure. You're going to receive this figure and you're going to pay the premium. What is going to be the outcomes there? Come on, give me a figure. Give me the figure. Is it equals to, sorry, this is going to be how much? So I'm copying this figure down again, sorry. It has to be multiplied. You're going to get a dollar amount. How much is that? 78? Check. Sorry, correct? Liu, yeah. Premium in dollar, yeah, very good. Multiply by that, you're going to 783,344. Okay, so total in all in, just give me the figures, please. Total in dollar, check, is it 22472,436? Okay, that's going to be the net receipts. Good, done. That's about it. Simple as it is. Then you must come to a conclusion. Yeah, you need to come to a conclusion. Which one is going to be the best hedging strategy? So that one you bring it inside the report. Okay, that one you bring it inside the report. I'm just going to give you a conclusion here. The forward was how much? The forward was 23,118. 23,118,000. The futures was, check, is it 23,127,387. And the third one we just got currency options. You're going to get 22,472,436. Okay, so we're going to say a conclusion. You're going to write a few things. Okay, I believe you can write, but of course this is going to be the best one is going to be receipts. You choose the receipts that's going to be the highest receipts. Is this 23127? But this is very close. This is very close. Very close. If I am going to decide, I'll choose forward, because forward is what are you going to say? Forward is fixes the contract. Forward locks in the contract. Forward is legally binding. Okay, forwards are simple, straightforward, straightforward, easy. Futures, it's also locks in the rate. Forward futures also legally binding, but futures have got complications. What? Margin payments is required. Is that okay? You need margin, and the thing is marked to the market. Is that okay? It is marked to the market. I hope you know what I'm talking here. On a daily basis, where gains or losses will have to be adjusted and calculated. If it's a loss, you got to pay. All right. If it's a gain, you're allowed to take out. Options, on the other hand, you're going to say, this is the worst, in this particular case, this is the worst receipts that you can ever think of, but you can take what? Can take advantage of favorable currency movements. So that means there is a downside is protected, upside is unlimited. You can dream for the higher ground in options. Options is where you can go better when you don't exercise. But forward and futures, sorry, it locks in. Whatever happened, it locks in today. But for, what else are you going to say for option? Premiums are usually expensive. Just sum up one small paragraph there. Usually there's 3 to 4 to 5 marks in that case. And finally, you're going to make one conclusion. We suggest forward. I'm suggesting forward. You want to suggest futures, go ahead. Go ahead, you still get the marks. I'm suggesting forward because it's less complex. And in this case, very close to the best one, which is very close to futures. Not so much of a difference. But if it's going to be, put it this way, if this is going to give you 80 million, this is 23 million, obviously my answer is going to be skewed to futures. Is that okay, everybody? Currency, done. The only thing we have not done is, of course, currency, money market hedge. I think that's basics. And also currency swaps. I don't have time for currency swap. I gotta be frank with you. Okay, currency swap, you do the question called BURREC. BURREC, B-U-R something like that, R-Y-E-C. I have included that in this focused questions. It's one of the past year questions. You can always download the answers from the ACCA website. Are you all okay? Any questions before we move on to interest rates? Interest rates, 51% chance of it is coming out. Okay, any questions you have, you can ask me. By the way, is there any prayers break or whatever at this hour? You must let me know, okay? Because I'm not aware of Pakistan timing of the prayers break. I must apologize, I forgot to ask you this one. Is there any prayers break, admin Kishore? Is it okay if I take a okay? If there's any prayers break coming up, you let me know because I can plan my break here. Arab, today is the last day for the webinar. Okay, I think Prepare to Pass is designed to go for a 4 days webinar, and I believe there are so many other presenters have done a very good job. Please go and search the archive of the Pakistan what do you call this, Prepare to Pass. There's a lot of okay, Ken, please offer 10 minutes break. Saddam Hussein is asking, so we got to give that. Okay, we'll take a 10 minutes now. It's I'm not sure what time is in your place now. We'll take 10 minutes now. Yeah, I think you can go and pray and come. Okay. Okay, are you guys back? If you can hear me, please say something. We're going to start doing a question. Okay, let's see. All right, Liu is back. Okay. Okay, can we start? Can we start? Yes, okay, good. Let's start. Now what are we going to do now is going to be on interest rates hedging. I must say we have only 1 hour to impress you. Okay, we're going to do this. I'm going to do this question called "What a Girl." This was also written as an article recently by your examiner. Okay, your examining team actually wrote this article explaining how to go about this. You can always read that up, okay, in case you want more clarity. Okay, but at this time we're going to see what is the required for part A. Is it okay? Part A, just going to do part A for 18 marks. This one is commonly tested in exam. Just want to tell you, this is commonly tested in exam. Treasury function, single, decentralization, all this, please read up before you go for the exam. Okay, just a tip from me. Okay, recommend a hedging strategy for dinar, I think it's dinar, okay, whatever, $27 million investment. Investment means you have got surplus money. You are not you are going to be a lender. Is that okay? You're not a borrowing party. You're going to be a lending party. On the hedging choices that are being considered, interest rates can increase by either 1.1% or decrease by 0.6%. Support your answer with appropriate calculations and discussions. 18 marks over there. Okay, let's go simple. Okay, you can read up all this yourself. Today, we're just going to go into the important words here. The first paragraph is for you to answer the second part of the question. Okay, assume today is 1st of October 2017. The Central Treasury Function has just received information that it's going to have future transaction in euro. Local currency dinar. Subsidiary is expected to receive dinar on 27 million on 1st of January 2018, and you're going to make an investment there. Okay, so you're going to get some money on 31st of January. Okay, today is 1st of October, 31st of January. You're going to get these things down there. Okay, let me just go down here. Okay, can read up all this. Okay, too many papers. Okay, right. Let me get rid of all this. Okay, start a new page. Okay, when you do this interest rate, make sure you get the timeline correct. That is the most important thing in interest rates. Today is 1st of October, very important date. 2017. The day you're going to get the money is 31st of January. 31st of January is the day where you're going to receive the money, and the day where you're going to invest that money. That means you're going to withdraw that money from your bank or your investment, most probably in 5 months until 30th of June. 30th of June. Okay, listen carefully. All right, you're going to get 27 million today. So from today to here, I'm sure you can tell me, but there are some students giving the wrong dates, okay? Can you please tell me what is the month gap there? The first one here. Yeah, I want to see who's going to answer this. How many months you have it there? How many months you have that thing there? 4 months period. Okay, very good. 4 months. So this is going to be 4 months period. Very good. And how many months you have it here? Or put it this way, 5 months. So you're going to invest for 5 months period. So this is going to be a 5 months period. Okay, that's it. Now, a small tip from me. What do once you got these 5 months and 4 months and the dates, you take whatever ink you have and you please close this off. You don't want to see this. You don't want to see this. You never see this in your examination paper. You need that to find the 5 month. But once you got the 5 month, throw away the last date, because candidates choose the futures based on that thing. That's a big mistake. You should never look at the day where you're going to do the settlement, the last date. Okay, this is an important date. This is an important date. 5 months period is important. Okay, now moving on. Water Girl Treasury team is aware that the euro is going to be uncertain. Okay, the base rate in area is 4.2. This is the base rate. But as an investor, in this case, I have chosen a question called investor. You believe that it can invest the fund in area at base rate less 30%, 30 basis point, 100 basis point is equals to 1%. So 30 basis point is equals to 0.1%. Okay, good. There's a chance that interest rates will go up. That's good news for you. And there's a chance that interest rates will fall. That's a bad news for us. And you're going to have 3 contracts. They only want you to do 3 things: forward rate agreement, interest rate futures, and options on interest rates futures. And then they give you the FRA over here, and they give you futures. I'm rushing through now. I think I'm rushing. Yeah, I'm rushing already. Okay, time is going to be difficult to finish this question, I think. So let me just go through as though you're a student. Okay, as though you're a student. So this is going to be the futures prices, and you must understand the interest rates. You cannot buy and sell interest rates. So what you're going to buy is the interest rates futures. Interest rates futures are like bonds. Is that okay? They are quoted per 100. And if it's going to be one, let's say, for example, if this is the price, that means the interest rate is 100 minus this, 94.8. So if I say interest rate is 6%, that means the treasury bills or prices of the bonds or the futures is going to be quoted at 94. You guys okay with this? This is the inverse relationship here. When interest rates go up, what happens to this? This is going to be 92. Am I right? It's inverse relationship between interest rates and the bond price. You must know this fact first. Inverse relationship. Only then we can decide to choose buy or sell or whatever later. Okay. Now, and then you got this futures options contracts here. All this is there. And then they say it can be assumed that the futures and options contracts are settled. Basis is the difference between, this is a basis diminishes to 0. There will always be some basis at a constant rate. Okay, there will not be any basis risk, and there's no margin requirements. Okay, no margin requirements and all that. Come, let's do it. First thing we're going to do is the FRA. FRA, I'm going to take a shortcut view. I'm just going to use the calculation for the percentages. Is that okay? You can calculate the amount by looking at the suggested answers. I'm just going to give you an overview of the calculation on the percentage annual rates here, okay? So we're going to choose an FRA. What is the FRA that is required? There are two FRA that is required here, 4.9 and 5.10. 4.9 and 5.10. So you're going to have here 4.9 and 5.10. Now the FRA is going to be simple. You go in and you come out. When you go in in the 4th month, you come out, you're going to come out in the 9th month. So 4 verse 9 FRA, or here they put dash. So you put dash there, no problem. You put a dash FRA and there's one rate only given. You just take that rate, 5.02. 5.02% is the rate that you're going to lock in today. Okay, you're going to lock in. End of the day, you're going to feel the lock-in base rate. This is not the rate you will end up paying, or sorry, receiving. This is the rate that you will end up locking in end of the day. Okay, you're going to lock in the rate. Okay, good. There are two scenarios here. There are two scenarios. Organize your answers properly. Okay, organize your answers properly. First, now the concept is this. This is going to be two dealings. Today, 1st of October, you are going to an FRA bank, which is usually the investment bank. These are the gambling bank. It's like they gamble on all the way. Investment bank. You go to the investment bank and you buy an FRA at 5.02 and you go home and sleep. On 31st of January, you will walk into the commercial bank to actually deposit your money. That one, it's going to be subject to interest rate going up and interest rate going down. So what we're going to do, we're going to have two scenarios, scenario 1 and scenario 2. You're going to have base rate going up by 1.1% and it's going down by 0.6%. Oops. Okay, good. Now, okay. Then what you have? You're going to have, you're actually going to lend. You're going to lend to commercial bank. Commercial bank. Okay, first scenario, you're going to lend to commercial bank based on the base rate today, which is going to be how much? 4.2. 4.2, but it's no longer 4.2. For the first scenario, it's going to be 4.2 plus 1.1. Okay, 4.2 plus 1.1. And you are going to show your face, and let's call the, what do you call the spread here? 0.3 basis point. They will minus from that. Banks want to make money, correct? Banks want to make some money from you depositing there. So it's going to be 4.2 plus 1.1 minus 0.3. The minus 0.3 is always there. Only thing that's going to come and change this is going to be, are you happy here? Scenario 1, you're quite happy because interest rate went up. 4.2 plus 1.1, take away 0.3, it's going to give you 5%. Is that okay? Check. Is it 5%? Scenario 2 is going to be 4.2, but it's going to take away 0.6 from the base. But since you're a lender, you're going to minus 0.3. If you're a borrower, usually it's plus 0.3. So in this case, it's 4.2 minus 0.6. minus 0.3. Is it 3.3%? Okay, very good. I have people helping me out here. Okay, very good. So then what you have here, you are going to have, this is where you do it today, and this is separate agreement. Okay, you're going to sign an agreement with the lending bank. It could be maybe HSBC, but you have gone with the investment bank, maybe another bank, or could be the same bank as well. It doesn't matter. Maybe it's a different floor this time. Okay, you go to get the settlement from, you're going to get the settlement with the investment bank. Now you have locked in the rate. Actually, you have locked in the base at 5.02. If you have locked in the base at 5.02, but in this case your base ended up to be 5.3. So but you have locked in at 5.02, so you are receiving party, so you will have to pay because you got more, right? You got more here. Did you receive more? You can't get that. You have locked in at 5.02, but in the event you receive more, you cannot be happy because the investment bank will do some adjustment to your bank balance or whatever. They ask you to pay how much? How much you're going to pay? 5.02. That's what you have to pay for the base rate, but you have locked in at 5.3. So all in terms of percentage, I'm doing the percentage method here. You're going to get here how much? How much is it going to be? This is going to be 5.02 take away 5.3. Is it 0.28? You're going to make a payment, so I'm going to put a negative. The other case scenario, you lock in at 5.02, but your base ended up to be only how much is that? 4.2 minus 0.6 is 3.6. So this is going to be 3.6, but you have locked in at 5.02. So you're receiving less now. When you're receiving less, you can go and reimburse. Is that okay? They will give you the difference. They will give you the difference of minus 3.6. It's going to be 1.42. It's going to be a positive figure. And there you go. Let me get the line straight. Okay. Okay. Now, so that's what you got there. So net off, you're going to get 4.72. Both case, you should get the same rate, 4.72. This is going to be your annual percentage rate, or you want to call it effective interest rate. Go ahead. Annual percentage rate. First time you write it in full. After that, you can follow through by APR. Annual percentage rate. If you want to check, you have locked in at 5.02, but that's locking the base rate. When you minus off 0.3, what do you get? You should get 4.72. Is that okay? You should get that. 4.72 is what you should get. Okay, any questions here? 1.42. Okay, all are helping me out today. Maybe you want me to finish this question, because yeah, I hope I can finish it. I just hope I can go up to the conclusion here. Okay. Now, once that is done, we're going into the futures. Now, to do the futures, you must remember a few things. Okay, you must remember a few things. Futures interest rates is linked to interest rates futures, which is going to be the interest rates futures, which is denominated, it's going to be the base or the attached, the underlying thing is going to be the government bonds. Is that okay? Government bonds. If interest rates go up, treasury bills or interest is going to go down. If interest rates go down, this is going to go up. This is all inverse relationship. Today, what we're going to concentrate is this. We're going to concentrate is this. So interest rate, my worry here, you are afraid. You think if it's going to go down, you're going to do something. But when you think it's going to go down, this is going to go up. So when I come and tell you, oh my goodness, interest rate is going to go down, you will faint. Let's say you faint. Okay? Because you have got millions of dollars in the bank. Okay, let's say you have millions of dollars in the bank and I come to you and say interest rate went down. Straight away you fainted because you're going to die. But if I come and put it nicely, all the interest rate futures are going up. What is going to happen to you? You must still faint if you understand what happened. Is that okay? So if interest rates is going to go down, the interest rates futures will go up. Anything that is going to go up, I put it here, anything that's going to go up in futures, you're going to buy futures. Okay? Because this is going to be the product that you're dealing in interest rate futures, not the interest rates itself. You're going to deal with interest rates futures, which is inverse relationship. Futures, so the worry is, the downside risk is interest rates is going to go down. As a lender, you think interest rates is going to go down. In other words, futures prices are going to go up. So if futures prices are going to go up, anything that's going to go up, just now before the break we said, anything that's going to go up, you quickly buy the futures. In options, you always buy. Remember, in options, you always buy options. Okay, you always buy options in options. And what do you buy? If anything that's going to go up, you will want the right to buy. The right to buy is going to be what option? So you're going to buy what option for this particular case? You're going to buy, anyone can answer me faster. I'm waiting for you. Yes, you guys are quick. Emma, very good. Call options. Then how come students putting put options wrongly? You're all putting call. Yeah, you guys are good. It's going to be a call options. Okay, the opposite stands for the borrower. You can slowly after the session, yeah, you're going to visualize the borrower as the story that I said here just now. Okay, all of you clear with this lender? All of you clear with this lender? Future is you got to buy future. Option, you have to buy a call option. Okay. Yeah, because they panic. We don't. Very good. You guys are having a coffee, yeah, and relaxing, listening. Okay, in exam, yeah, I hope it's still going to be the same case. Okay, take this into the exam hall. Take this spirit into the exam hall. Okay, very good, Emma. Okay, so that's the starting point here. Now we are going into the hedge itself. We are going to the hedge itself. Okay. Futures. Okay, futures. We are going to talk about the type, buy or sell. No repeats here. It's going to be buy. We still call it interest rates futures. You can say buy futures, no problem. No, you can go. You can either. It's not. I forgot to tell you. You can say go long. Go long on futures. You buy now, sell later. It's considered a long position. You sell now and buy later. It's called short position. Yeah, if you're confused, forget about this. But you can take long. Yeah, they will accept long, they will accept short, whatever the case is, if it's correct. So buy or sell, it's buy. Second, we're going to talk about the time. This is going to be very important. The futures you have here, you're only given, what are you given? You are given, yeah, these are the futures price. You got December, you got March, you got June. Now, what is important for the time is you need to see the timeline. You need to go and see the timeline. You see, I blocked this already. I blocked this already. You can't see this. Okay, you can't see the June. Okay, I blocked this already. That means it's definitely not June. Okay, because purposely examiner put June. He knows some of you fellas may choose June, not you, but the whole world population. Some of them will choose June. 60% will choose June. That's the passing rate. 40% will pass. Okay, June is out. So the idea is you must choose the day, the first contract that is going to expire after the day you close position. After the day you borrow or lend is 31st of March. What contract comes in after that? After that, is that okay? You must choose the contract after 31st of January. December is expired already, so we're going to choose a March contract. Is that okay? We're going to choose a March contract for what do you call this? Futures. So it's going to be a March contract. March contract, which is going to be what's the 94.78. Okay, we're going to choose the 94.78 expiry. Very good. All of you got March. Nice. Okay. So you're going to choose a March 2018. Okay, very good. The date is there. 2018. Doesn't matter. 2018 March contract at 94.78, which is equates to an interest rate of how much? Can you tell me what is the equates? It equates to an interest rate at about how many percent? You take 100 minus this 94.78, you're going to get something like 5.22, Dinesh. Okay, everybody got it correct. Okay, 5.22%. Okay, 5.22% is going to be there. Okay, so that is for futures. And what we have to do is we need to go to the third one, which is going to be the number of contract. Is that okay? All this giving you mark. You say buy futures or go long on futures, give you mark. You choose March futures, you're going to give you mark. You're closing earlier. You're closing on 31st of January, but you're going to go for March expiry. So there will be 2 months, yeah, in the future. So number of contract. Number of contract, what you do is you use a little formula. You take your amount of your hedge, which is dinar 27 million. That's the amount that you need to protect, and one contract has got 500,000 contract size. And it's going to be simple as that. That's what you think, but it's not the thing, because the thing here is you need protection for 5 months. Is that okay? You need protection for 5 months, correct? You need protections for 5 months. And the contract life, it's only a 3-month contract life. So you need to use an equation. You need to slightly take more contract to protect, because you need protections for 5 months over the contract life valid only for 3 months. So you overdo it a bit. And so far, examiner has put the contract size in beautiful contract size, except for the first question that he created was electoral. That was a little bit of a more practical question. Is that okay? In practice, it's not going to be beautiful. But so far, the examiner have created all beautiful, except for the electoral question, I think 2011. 11th question. Then after that, he's putting it all simple. He wants you all to pass. Is that okay? He wants you all to pass. 90 contract. Don't ask me to design overdo it. Okay. There so far, just put it beautiful, beautiful. 90 contracts. And then what you need to do, these are the things you're going to get marks. You're going to get marked for this. And the next thing you need to do is you need to do a basis calculation. Is that okay? The basis calculation is what you need to do. The future price. You need to estimate the future price. Future price at 31st of January. Now I'm just rushing through. I'm just writing down what can pick up marks. Is that okay? What can pick up marks? This is going to be an estimation of future price. Estimation of future price. You're going to get here on today is 1st of October, 31st of January, 1st of October and 31st of January. You're going to get here spot rate and you're going to get here futures price. You're going to compare. The difference is simply basis. Okay, the difference is known as basis. Okay, so we are told that the spot rate today, it's how much is your spot interest rate? Spot interest rate, when I say you just take the base rate. Do not take the 0.3 at this stage at all. Do not take the company's position. Take the overall industry position. The base rate is now how much? 4.2%. Yeah, we'll take 4.2. You can calculate based on 100ths minus 4.2, or you can just leave it 4.2. So I'm just going to leave it at 4.2. And there's two scenarios here. The base can be now changing. The base can change by 1.1%. You're going to plus 1.1 and this is going to minus with 0.6. So can you plus 1.1 to this figure? We are going to get here a figure of 5.3% and this is going to be 3.6%. Okay. And the futures price is what you are going to deal today. Now, the futures price that you went today is this. This is the price you went today. These are the quoted price for March, December, and June today. These are the price today. Technically, this is the price on 1st of October. I don't want this. I don't want this. So I take 94.78. But I can't put 94.78 because I've decided to choose on the interest rate format. So we're going to take here 100 minus 94.78, which is going to give you 5.22%. Don't worry about which is bigger, which is smaller. Just take this figure, and this is going to be 102 basis. The basis is futures interest rate is expected to go up. Okay, 5.22. The basis is 1.02, and this is a basis because this is today's price, 1st of October. This is going to be, I think it's going to be on the March 31st, March 31st, 31st of March, because this is a March futures. Futures price is going to forecast that maturity future price, which is going to be 5.22. So what you have to do here is, this is a gap for how many months basis. This is a difference between how many months basis. So if you look at it here, this is 31st of March. Here it's 1st of October. There's a difference between this futures price and spot price. So by 1.02. This is how many months basis. How many months is there? How many months? Students get this wrong usually. How many months? Okay, how many months? It's not 5/9. It is 6 months. Yeah, someone who's waiting for the name. Okay, no name yet. Okay, so this is going to be 6 months. Very good. 6 months difference. 6 months basis is 1.02. What are we doing? We are going to close earlier. Okay, we are going to close earlier. There's two scenarios here. obviously on 31st of March, these two will be the same. The basis is going to be 0. Basis diminishes to 0 on a constant basis. That's the assumption we always make in the exam. Okay, basis diminishes to 0. Okay, how many more months to go here? How many more? This is going to be on 31st of January. This is 31st of March, future price. This is going to be the future price. We need to find this. We need to find this. But first, we need to find this first. This is going to be the basis. It will diminish to 0 on a linear manner. But here we still have got 2 more months, like you guys said, correct? 2 more months. So what is going to be this figure? Well, it's 2 over 6 multiplied by 1.02. Are you guys okay? This is going to be 0.34. Okay, 0.34. Very good, Arab Sultan. 0.34. So now you got to put these figures here. Don't worry about this, whether this is positive or negative, but you have to make sense. When you said this is at 5.22, it will slowly flow down, and this was something like 4.2. It will slowly go, and it will meet that. All of them will meet up on this place on 31st of March. So if you close it earlier on 31st of January, there'll be still a 2 months basis. Futures is higher, so futures will always remain higher. That's the assumption. Is that okay? That's the assumption. So if this is higher, then this is also going to be higher by this amount. Can you tell me what are you going to get there? Can you please type it in? What is this going to be? If this is higher, this is also going to be higher. Okay, this is also going to be higher. How much is this? I'm waiting for you. Got the answer coming in. 5.64. Very good. Okay, 5.64. And the other one, the second scenario will be how much? This is 5.64. Take the red color. Okay, 5.64. Over here, this is also will be higher. Okay, this is also will be higher. 3.94. Thank you. Thank you. 3.94. Correct. 3.94, you're going to get that 0.34. Okay, 0.34. And that's it. So once you got this, therefore, you're going to come to a conclusion. The future price on 31st of January, it's going to be 100 minus 5.64. This is going to be 100 minus 3.94. The future price is going to be 94.36, and this is going to be 96.06. You got your basis correct. You got your futures price correct. Basis, if you get 0.34, you will get 1 mark. When you get the futures price set here, 1 set correct, you get another mark. Is that okay? So that is going to be the most thing that you must do. Now, another thing, just want to tell you is I follow the tick method. I follow the tick method. You can do without the ticks. It's a little bit longer. I follow the tick method. I know, I hope you know what you mean by tick. Tick is the smallest recorded price movement. Okay, tick is the smallest recorded price movement. And it's in percentages. Is that okay? It's in percentages. They didn't say what's the tick size here, but usually the tick size is going to be 1%. 1% is going to be, to move, for the change of 1% to happen, it must move 100 of the 1%. Okay, and we need to multiply with the loan amount or the contract size amount, which is 500,000. One contract size is 500,000, and the contract life is 3 months. So as though you are taking a loan for 3 months or giving out a loan for 3 months, the tick size is going to be, how much is the tick size going to be? It's going to be $12.50. Okay, this is not given in the exam. They usually give you, but if they don't give you, you calculate yourself. or you can do without ticks. Without ticks, it's going to take a long time. Yeah, it's going to be, it's like treating like an interest. Yeah, I'm not going to show you the method. Okay, we're just going to show you the tick method. Yes, Ahmad Taya is correct. 12.5. Some people will memorize this. They say, okay, 500,000 is 12.5. 1 million is 25. 2 million is 50. These are the three common contract size the examiner likes to give. But don't memorize that way. This is actually the smallest recorded price movement. Let's say the interest rate is 4%, want to move to 5%. It doesn't tick tock, tick tock, tick, tick comes from the word tick tock, tick tock. 1 minute got 60 ticks. Okay, so to move to 5%, it must move 100 tick, 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 tick. Then only it moves yet. So that is what I mean by this is going to be resembling the interest rate per tick. And one contract, assuming the loan is 500,000 and the life is 3 months, it's like an interest rate. Is that okay? It's like an interest rate here. So that's what you got to get this right first. So the key points are all here. Futures. I've not done options yet. I'm not sure whether I think I have to let go options. Okay. I think we have to let go options today. Okay. But we have like a few more minutes. Okay. To let go. But I'll tell you what to do for options. So okay, I'll just tell you what to do for options. You go and read up the examiner's article. Okay. Come, let me just move on because we only have 2.5. The webinar is already set to end at 2.5 hours. Otherwise, it's going to be heavy loading, it seems. Okay. All right. I must apologize if I can't finish. Okay. I'll tell you in advance. Okay. And but the key points I'll tell you, buy, put, and all the stuff. Okay. Now, let's move on to the actual outcome. Is that okay? The actual outcome itself. There are two scenarios here. I'll take a whole page for that. Okay. All right. Scenarios. Okay, yeah, I will recommend. That's what I want. I want a few minutes at the end to tell you what questions to do, Emma. Don't worry, I will recommend all the questions that you have to do at the end. Yeah, including my questions are comprehensive to cover the syllabus here. Yeah, the questions we have it here. But I need that 5 minutes. That is why I don't want to rush into options and I can't talk about that. Okay, last 5 minutes of this session is going to be important. Okay, so we're going to have actual interest. Actual interest cost 5% and 3.3%. Okay, 5%. How much is the interest? Because you know why 5%? Because the base rate went up by how much it went up with? Okay, because I skipped forward part. Okay, never mind. So this is going to be 5%. How do you get this? 7 million. Can I put 27 million? 27 million multiplied by, remember just now the forward contract with the commercial bank, it was 5%. Is that okay? Multiplied by 5/12. The interest that you are going to receive is 562,500. Second scenario is 27 million multiplied by 3.3%. Check out your forward contract just now. Okay, multiplied by 5/12. You're going to have here 371,250. Okay, so you're going to have here sorry. Okay, you're going to have here, this figure is going to be, how much is this figure? Correct, yeah, this figure, this is going to be the plus, okay? Next, what are you going to have? It's going to be your futures. Okay, let's get the futures out. Futures is going to be buy and sell. Okay, futures is going to be buy and sell. And in your head just now, you decide to do what first? What did you decide to do first? You decide to buy futures first, which means you are going to buy at this rate first. What was the rate that you decided to buy just now? Buy futures at 94.78. Is that okay? You're going to buy futures first. You're going to put here 94.78. And the sell futures is going to be how much as per your forecast just now? As per your forecast, you're going to have 5.64, but when you convert that, you're going to get 94.36. Okay, 94.36. So it's going to be 94.36. So giving you a difference over here, also the same, 94.78, and you're going to sell at what price? 96.06. Okay, 96.06. The difference is going to be something. This is not option, so you will make a gain or you will make a loss. Please tell me the difference. What's the difference here? The difference here is going to be 0.42, and this is going to be 1.28. Okay, 1.28. Okay. So what do you got? Which one is a gain? Which one is a loss? Come, tell me, type it in. Which is a gain and which is a loss? Wait, someone typing a wrong answer. What is it? Mutasa. Mutasa. What do you write? Okay. Well, I mean, Mutasa, okay, let me just tell you. This is interest rates receivable. Yeah. The basis we are using is interest rates. We're not using what do you call this? Treasury bill prices. Yeah. If you use treasury bill prices or interest rates, whatever the case is, end of the day, we compare these two. Where we compare these two, we compare these two. If this is high, we stick to this is high. Is that okay? Don't worry about negative and positive. Okay? Don't worry about negative. You want to put this first, go ahead. Doesn't matter. Okay? In exam, we just want the basis of 0.34 to be appearing in our site here. Okay, we know the basis is 1.02. And if the examiner or the marker can see 0.34, then from there you can work this out. Is that okay? I hope I answered your question, Mutaza. Okay. Coming back here, gain or loss. Which one is the loss? Which one is the gain? I think I say gain, number one gain, second one loss. First one loss, second one gain. There's a mixture. There's a mixture, okay? No problem, Mutaza, okay. First one loss, second one gain. Okay. Now, you must be very careful when you choose a gain or loss. Now, you must remember, futures are two sides of coins. One market you win, another market you must lose. Here, are you happy about it? If let's say you don't know, okay, let's say you don't know, are you happy about it when you are interest rate going up now? Interest rate going up, as a lender, you are happy. So here should be a loss. That's one way, no-brainer answer. But that's not the way I should teach you. Very simple. You buy at 78, you sell at 36. Obviously, it's going to be a loss, isn't it? You buy at 78, you sell at 96. Obviously, it's going to be a loss because here, sorry, this is going to be a gain. Am I right? This is going to be a gain. You sell at 96, you buy at 94. This is going to be, because here you were set as a lender, interest went down. Here you should be happy. Now, if you follow the tick method, this is going to be how many ticks? 1% is broken up into 100 ticks. 0.42% is going to be 42 ticks. Okay, it's going to be 42 ticks. 1.28% is going to be 128 ticks. And this is a tick losses. So your total loss here for the first one is going to be, futures loss is going to be 42 ticks. One tick is 1250. One tick is 1250. There is an equivalent of 90 contracts. You're going to make a loss, so I'm going to put a bracket of how much? The bracket is going to be 47250. Is that okay? 47250. And this is going to be number 2. You're going to make a gain. On this side, it's going to be how many ticks here? 128 ticks. Okay, 128 ticks. Multiplied by 1 tick. You're okay with this ticks? 1.27 percentage actually. 0.42 percentage actually. Okay, 128 ticks. It's going to give you a gain of 144. Okay, this is going to give you 12.5 multiplied by a figure of 90. Okay, multiplied by a figure of 90. That's going to give you an answer of how much is that? 100. Sorry, gain. No gain. It's best that you put a negative brackets and no brackets to easily identify. 144 is plus. Now, if it's going to be beautiful contract size, yeah, if your contract size is beautiful, and if your basis decrease on a linear manner, the interest rates is going to end up to be beautifully perfect. Same amount. 515250 received. 515250 received. Is that okay? So you have to find your annual percentage rate. Annual percentage rate, there are many ways of doing it. Like how you got this. You're going backwards to find this. So what we do, you just go backwards, you divide by 27 million, multiply by 12, divide by 5. Is that okay? Many methods of doing it. I'm just showing you the common one that everybody does it. 515250 divided by 27 million, multiplied by 12, divided by 5, if I'm not mistaken. How much is this? 515250 divided by 27 million, multiplied by 12, divided by 5. Help me out. What are you going to get here? Okay, let me answer questions later a bit. Okay, let me finish this first. 4.58%. Well, here, don't need to do again because the figures is the same. You're going to get the APR or annual percentage rate is going to be 4.58%. It should be the same. Yeah, because it is future. Future locks in the rate provided the contract size is beautiful. Basis reduces on a linear manner. Is that okay? Now, of course, options, I must apologize. You have to do it yourself. But I've taught you how to do the options. You have to choose what option. What option you have to choose? Let me just tell you that one at least. Okay? Option, you need to buy a call option. Okay? You need to buy a call option. Now, let me just tell you what are the important questions. Okay? Okay. Now, exam is, if I'm not mistaken, 21 more days. Is it correct? 20. I'm having a countdown as well with you guys. 21 more days we have for your exam. Okay? Now, what are you going to do in that 21 days? Obviously, you need to practice. Is that okay? You need to keep practicing. What you need to practice is basically you need to cover the core area of your syllabus. Yeah, you need to cover the core area of your syllabus. Cover the core. There are 5 core area in the syllabus. I think I've talked about it. Yeah, in the first day. Cover as much as you can on the 5 core areas. 80% will be there. Okay, you need to practice the past exam papers. If you can get hold of December 2010 onwards, or you can, if you can't, because ACCA publishes from what do you call this, 2013, I think, since they changed the format to 50 marker question. You can start by that also. If you're running out of time, means you just start with December, if I'm not mistaken, the Tremont paper, you know, the Tremont pilot paper, I think before June 2013. So June 2013 onwards, I think they publish. You do all this first until the hybrid March and 18 and June and 18 papers. Do all these papers in exam time condition. Is that okay? In exam time condition. So the questions that I would like you to do, of course, these are the questions I like you to do first. Okay, these are the questions I want you to do. This covers everything actually. Enia covers forecasting. Moranda, I think, are some forecasting and some bond valuation and all that. Bento is going to talk about. Bento is a rare type of question, not to say rare. It comes out like every 5 years one. I'm not sure whether there's a trend or not. Bento was a June 15 paper. Before that, there was one question called Proteus, if you still can recall. That was in December 11. So 4 years. So the next prediction will be 19. I'm not sure, but it's very similar. Okay, that means you are trying to find what do you call this? The company trying to obtain a loan. They ask you to find gearing and stuff. Same style of question. Is that okay? Now, what other questions you have to do besides this question? Come, please do a question called GNT. If you can't get the question, just get a revision kit. Sure, there's a question called GNT. June 11 paper. Okay, it's a June 11 paper. It tests us on duration. Is that okay? Bond duration. Please do the question called ARBORE. ARBORE. This is going to test you on capital rationing. Is that okay? Capital rationing. So far, there are 2 questions that appeared for capital rationing. After ABOR, there was one more. I heard that was not published. Okay, so there are two questions on capital rationing. So pay attention to ABOR. Make sure you know the multi-period capital rationing period. Okay, please do a question on, this is ABOR, right? Okay, besides this question, besides the core area, these are the small stuff I want you to try. Is that okay? Please do a question called either CHA1. CHA1 is good. Do CHA1 just in case. This is a ratio on performance measurement, etc. Okay, performance measurement, etc. Please do questions on latest one, triple time, which is on APV. I didn't cover APV. Triple time came out in March 2018. Yeah, March 2018. It's an easy question. Yeah, March was the easiest question paper, I think, of all time. Easy. Okay, so these are the little bits that you need to cover. So what are the important areas that we have for this coming exam? Okay, of course there will be a question on business valuation, merger and takeover. Make sure you know all the theories of it. Yeah, moderator is giving me some time. Time is up. Okay, let me just put in 2 minutes. 2 minutes, please. Okay, 2 minutes, moderator Kishore. I appreciate it. Okay, business valuation theories. Pay attention to risk management. Maybe the first question this time around. You never know. Never know. First question could be either one of these, or the third question could be international investment appraisal. Okay, international investment appraisal. This 3+ is going to fight for the first spot. Question number 1. Is that okay? Other areas, please make sure you know on real options. Real options, take note of this delay options. Okay, take note of delay options. Okay. Other than that, make sure you know a little bit on forecasting. Okay, one more, just a small tip. Last exam there was something on swaption. Okay, there's something on swaption, so please read up some information. So far it is up. It's not published. So make sure you know what is swaption all about. This is an option to enter into a swap. Okay, so these are the areas. Of course, you must also don't forget to read this Sunil's article, which is on Islamic finance on appendix, as well as this examiner's Islamic finance article. Quite some time it's taking a holiday. Okay, Islamic finance is taking a break for some time already. Don't forget, there's one more article I forgot to put in, was behavioral finance. Behavioral finance only came out as only 6 marks or 7 marks question. That's it. There's more behavioral finance to be. They asked us on share valuation. Okay, but you must also look at the merger and takeover behavioral type of finances. Okay, pay attention to these 2 articles, Sunil's articles, and don't forget this exchange rate by William Parrott and real option. Now, talking about Sunil and William Parrott, let me give you a tip. Go and get their mock exams. Is that okay? Go and get their mock exams. These 2 people I know write mock exams written for specific exams, not written for any exam. Yeah, you go and get their mock. If you can afford it, just go and get their mock exam. I heard they mark it according to exam standard. Is that okay? If you got the cash, I mean, I think they're not giving it for free. Yeah, just go and take a look at it. Just go and say hello to them and say how much is it. Yeah, I'm sure these 2 people needs no introduction. Is that okay? These 2 people needs no introduction. You can find ways to get hold of them. Yeah. Yeah. I think that's about it. Let's take some questions. Oh, there's a lot of questions. Kishore, just bear with me for 1 minute. I just want to answer a few important questions. Okay, one, gain losses. Okay. Okay, assumptions. You just listen to my yesterday's videos, please. There are 3 important assumptions. One is investment appraisal assumptions. One more is real option assumptions. And one more is going to be on this particular assumption on business valuation. Okay. Jory, your name? Okay. No problem, Mutas, you're most welcome. Okay, options and futures and mark. Yeah. You want to know the questions? You want to know the questions for interest? Sorry, what do you call this? Currency questions. You do Lirio. Yeah, you finish off Lirio. You do Kenduri or Kendrai. Some people call it Kendrai. You do the CMC currency part. Interest rates. You're going to do other questions you can do is Daikon for interest rates. You can do Keshi for interest rates. This has got a swap element here. Interest rate swap element is in the CMC as well. Please do questions that we did just now. Wonder Girl, complete it. Is that okay? Complete the thing. Get some callers knowledge as well. Okay, callers, caps and floors there. Okay. All right, I think it's time's up. Kishore is giving me a hand. I would like to thank all of you for attending this course, and I wish you all the best for your exam. Please, yeah, you can email me for any things that you think you want to ask me, any questions. Yeah, you can please email me. My email is just at the bottom of every page in this course notes. I want to thank you to Kishore and his team, Ahmad and Almas, for being so nice, for allowing me to come and talk something for the past 4 days, including today. Okay, good luck to all of you. Do keep in touch. I wish you the best. I pray for you. Thank you and goodbye.